Hello, everybody. I'm Suz Mac Cormac. I'm a partner at Morrison & Foerster, but you can just say MoFo. And we are going to do a quick introduction. Those of you who've known me for 15 or 20 years know that there's nothing I like more than talking about corporate form and governance. And I can't believe that 20 years ago when I started focusing on the space, people would walk away from me dazed, and now people actually want me to be on stage discussing this stuff. So it's very exciting. I started focusing on climate and sustainability in 2001. And when I realized early on that really philanthropy is not the answer. Philanthropy is less than 0.25% of our capital market. So when we are addressing huge issues, and we've been talking, and the speakers have just been amazing. Greenfin and GreaseBiz have done an amazing job putting this together. You know, we're addressing inequality, we're addressing climate. You can't solve those issues with less than 0.25% of the capital markets. You need all of the capital markets. So I've spent the last 20 years developing scaffolding for aggregating funds, instruments to deploy capital, and the underlying corporate form in a way to allow the mainstream capital markets to really have impact, not greenwash, but have impact. And today we're going to be talking about one of those, which is the Public Benefit Corporation in Delaware, which is substantially similar to what I drafted in California, the Social Purpose Corporation. And I'm really honored to be joined by Kevin Smith and Margot Brandenburg, who are going to introduce themselves from Ford and Goldman. Kevin?
Great. Well, good to be here, and thank you for the GreaseBiz team for having us. It's great to see so many friendly faces. It feels like we're back to 2019, which is nice. But anyway, I'm Kevin Smith. I lead the ESG advisory practice within Goldman Sachs' investment banking unit. I have been with the firm since 2004 and have spent the better half of that career in ESG and sustainability, originally focused internally on Goldman's own practices, setting our policies, procedures, and so forth. And then the last 5 or so years really focused on our client side and helping our clients access the capital markets or think about M&A opportunities around ESG and sustainability topics.
Thanks, Margo.
Hi, everyone. It's an honor to be here with the two of you. My name is Margot Brandenburg. I'm the Senior Program Officer for Mission Investments at the Ford Foundation, based here in New York City. Ford, if you're not aware, not the motor company, but the foundation is the largest social justice foundation in the US, but we also operate around the world. And our mission investments team is a little unique for philanthropy in that we manage 3 pools of capital. We have a $1 billion allocation from our endowment for investments that advance Ford's mission and values. We have a catalytic capital portfolio, and we have a grant budget. And the purpose of that is really to accelerate sustainability and equity in the capital markets. So thrilled to be here.
Well, thanks. And today we're just going to give you a little snapshot of what a PBC is, and obviously how it can be a tool in both the philanthropic markets and the mainstream capital markets, which is why I'm honored to be joined by Margo and Kevin. I have my notepad. I teach at Berkeley and also at Stanford, and I can talk about a nuance of the PBC for hours on end. So I'm going to give you, in I think a minute, the overview so you understand what we're talking about here. The Delaware PBC is not a B Corp. A B Corp it can be a B Corp. A B Corp is a certification. There's a fabulous organization called B Labs that certifies companies. You send in, you pay a licensing fee, they certify. It is also different from the benefit corporation in states like New York. The benefit corporation is a very different beast. We are talking today about the Delaware Public Benefit Corporation. And there are 4 things you need to know about the Delaware Public Benefit Corporation. Number 1, it has dual fiduciary duties. So shareholders and management agree on a set of ESG principles which are codified in the charter, to which boards and management have a fiduciary duty equal to the pecuniary interest of shareholders, number 1. Number 2, the board and management must consider stakeholders in addition to shareholders in their normal course of operations. They don't have a duty to them. Number 3, There are heightened disclosure obligations. I know you've been hearing a lot in these sessions about the SEC, the new disclosure rules. They fit in with them. And number 4, it insulates the board and management from liability if they focus on the public benefit and to the detriment of the pecuniary interests of the shareholders. For those of you who have some law or corporate governance, it provides the same protection as the business judgment rule. So with that background, Margot, starting with you, how can the PBC be a tool in the philanthropic world?
I mean, Suz, I feel like you took my lines when you started. I mean, we are interested in this topic for the reasons that you mentioned. Ford's mission is to promote a more equitable, sustainable, and just world. And there just is not enough philanthropy by orders of magnitude or by zeros to get us where we need to be on climate change, on inequality, on a functioning democracy. And we don't have a choice. We have to ensure that the private sector works for, not against, the things we care about. Transition to a low carbon economy, gender equity, food security. We heard that from Neely on GFANs. We need to see it everywhere, basically. And we've been encouraged as more and more companies have really touted their sustainability bona fides, responding to a clear tsunami of interest from consumers, but also from workers, particularly younger workers, investors. But there's no inherent accountability in many of those sustainability claims, and that creates a clear risk of purpose washing. And among other things, it makes it difficult for genuinely mission-driven companies to distinguish themselves, which is why we think the PBC is such a critical and foundational tool to allow those truly mission-driven companies to self-impose some guardrails, to self-impose some accountability, and to really differentiate themselves. And just, I guess, to offer one example of how it's landed recently for us, we invested last year in a company called Novata alongside some large commercial investors. And we invested with our endowment, so we're looking for a competitive financial return, but we invested for the impact. And the management team came to us and said, we're going to be a Delaware PBC, which was reassuring to us that they took, that fidelity to mission seriously and were eager for that accountability. At least one of our co-investors, I think, really got skittish and had pause when the management team said they wanted to be a PBC. And one of them asked if a PBC could ever lay off workers because, weren't they obligated to always serve all the stakeholders' interests all the time? And so we had a refresher. Suz, we should have called you, but we luckily found a different lawyer that and was able to sort of level set what a PBC is and isn't. And everyone got on board, and the company's off to the races and has grown. And that PBC status is it's really central to their DNA, to their North Star, to how they've hired and how they're positioning themselves. And we've seen that across any number of companies.
So one of the things that I've seen is, and you've just bolstered it is allowing folks with philanthropic capital to leverage that as catalytic capital to attract the mainstream capital markets. And Kevin, in the mainstream markets, I know you focus on M&A and particularly ESG and impact in M&A. How is the PBC viewed both in the M&A context and in the IPO context? There, just for those of you who are not counting, because I count on a daily basis, there are 19 publicly traded Delaware PBCs right now.
Yeah, I think that context is helpful. Just, I think broader picture, there's 300 or so PBCs. So most of the market has historically been in the private markets. And to Suz's point, 19 are in the public markets. I think 17 of which were PBCs before they went public. There were 2 conversions, I think Viva and United Therapeutics, if I remember correctly. And so, the question around is the broad capital markets kind of conducive to PBCs? I think, yes, currently there are companies that have had successful public offerings that have been in that format. There are certainly dialogues that go on in our M&A discussions with both financial sponsors and strategics around what does it mean if they're thinking about acquiring a company that is in that form. And in some cases and Suz, you'll probably have your own views on this, is there's a question around, is that an attractive feature for maybe a founder-owned businesses that's set up as a PBC, and the ability for them to maintain that post-acquisition. And so we're having a number of discussions with clients on the due diligence front, but also thinking about kind of does that add additional value to their bids or their offer in terms of situations that have public benefit corps as a potential target. In the public markets themselves, when you think about some of the drivers, I mean, Margo mentioned some of the drivers that we've seen, the broad macro ESG assets that have been formed, and some of the prior panelists have talked about that. But I do think there is a growing sense of kind of corporate purpose, and particularly when you think about the large assets that have been raised in the space, a disproportionate amount of them is on the active side. And so active managers really want to understand the ESG elements of the businesses that they're investing in. And not to say that PBC is the solve for all of that, but it's one indication that a company is taking this seriously and likely has kind of the better reporting and better kind of processes in place to appeal to those active owners. And so we are seeing greater traction from that perspective in the public markets. We often get the question on, my clients that are thinking about going public will, kind of have two questions. One is, will this open an additional pool of capital for the offering that we wouldn't have gotten otherwise? Like, is there manna from heaven that is going to help with a better successful offering? The other question is the flip side of the coin is there an additional risk here that maybe closes off investors to going public? And I think what we've seen is the answer is kind of no to both. It isn't a magic bullet for ultimately getting to the high end of the range when you're pricing an offering. And it likely isn't going to present an extreme amount of risk in terms of your execution. But there are a number of benefits that we've seen, particularly as I think about the positioning of the business. So a PBC tends to be part of the storytelling, tends to be part of the features that can demonstrate that a company has higher growth and they're focusing on a broader set of stakeholders, which helps in the art of the pricing of a security. And so certainly anyone who's been involved in pricing an IPO, it's a bit more art than science in many cases. And so we've seen this as kind of one of the ingredients of a successful offering, is to demonstrate broader kind of ESG capabilities for the company.
Okay, final question for all three of us. We'll start with Margo. What's next? What are you seeing next for the PBC?
Couple thoughts. No one has a crystal ball, but I mean, as has been discussed, the data ecosystem for all this is still pretty nascent and rife with fragmentation and non-correlating standards. But we know that good, high-quality data and stakeholder impacts are necessary if the boards and management of PBCs are going to fulfill their multiple fiduciary duties. And so I think, we have to see a maturation of that data ecosystem. I think, again, stakeholders are going to demand transparency for those public benefits and those stakeholder impacts. And then I think, Suz, you started to touch on this. It's an investor in a PBC that holds that PBC accountable for its public benefit, for its impacts. But for the most part, institutional investors don't have a similarly expanded set of fiduciary duties. And so there's a bit of a mismatch. And so, thinking ahead on policy and regulation, does the focus need to shift to investors first to enable and then to maybe incent, dare I say, require this broader set of fiduciary considerations? We're already seeing that in Europe with their EU taxonomy. It feels strange, I'll be honest, in a week where the Supreme Court has gutted some of the policy and regulation that I at least hold dear, to think that that's possible. But, the arc of history is long, and I think it will bend toward enabling policy and regulation.
Kevin?
Yeah, I think the forward is there's likely to be more PBCs, both in the private markets as well as in the public markets. I think the growth of capital and private capital in particular and ESG trends will likely be a net benefit for PBCs as a structure. There's some, because there's only 19 in the public domain, there will be some, I think, pressure testing and precedents that will be set on everything from all the points that Margo made to things like even shareholder activism, and does that present as an opportunity for a corporate form to be better or more resilient to unwanted acquisition attempts and so forth. So we will see on that. I think Suz, I know you have views on that, but that's one thing we're kind of following very close.
And so I'll just end by picking up on some of the themes. Number one, it's being referred to as a sweet pill. So if you've been following the news, there are more people who are considering it when they want to fend off unwanted takeovers, because a board and management, a board can say, no, we're not going to take the higher price because you are not focused on our public benefit. Number two, watch the rise of shareholder activism in this space. shareholders are like, why am I going to have a proxy just for one thing? I could actually require that they change corporate form and focus on a whole range of things. And 3, dual fiduciary duties. All of the publicly traded PBCs to date, there has been almost complete overlap between what they do to make money and their public benefit, private education, education space, education, infrastructure, sustainable infrastructure. However, an oil and gas company could have a public benefit of climate while they're in the energy generation and then be protected from liability if, for example, their stock price drops because they invest more heavily in energy transition. Just want to throw that out there. That's it. Thank you so much. And thank Kevin and Margo for joining me.